the key to real estate is taking a through cycle view. And if you can come out, back to our original comment, with strong relative investment performance out of the cycle, you're going to do well.
Prominent CEOs, leading economists, iconic investors, insights from the experts. The Walker Webcast with Willy Walker. See who's next.
Welcome to another Walker Webcast. It is my great pleasure to have David Hunt, the president and CEO of PGIM, join me today. David, let me do a quick bio intro to you, and then we'll dive into our conversation, which I've been very much looking forward to. David Hunt is president and chief executive officer of PGIM, a leading global asset manager across public and private asset classes. Before joining PGIM, Mr. Hunt was a senior partner in McKinsey & Company and co-leader of its North American asset management practice. Mr. Hunt has served on a variety of nonprofit boards, including Lincoln Center for the Performing Arts, International Rescue Committee, Graham Windham, and Toigo Foundation. He is a life member of the Council on Foreign Relations. He earned a bachelor's degree in engineering from Princeton University and an MBA from Wharton. Many people say that I have nothing but Harvard Business School graduates on the Walker Webcast, and I want to underscore that I've had back-to-back Wharton.
So diversity for you is Wharton. That's terrific.
I had a Wharton grad last week, and I got a Wharton grad this week, so I love it. We're getting some real insight, David. We're getting some real insight. It's a pleasure to have you with me. Let me start here, David. PGIM manages $1.4 trillion, and I remember Alan Greenspan used to say $1 billion here and $1 billion there, and at some point you actually have real money. In your case, it's $1 trillion here and $1 trillion there. You're pretty close to having $2 trillion of AUM at PGIM. Is that the goal? Is the goal to continue to add AUM at PGIM and go from $1.4 trillion to $2 trillion to $3 trillion?
You know, it's not the goal, but I hope it will be the result. And maybe I can explain a little bit there. I think that the most important thing for us as investors is to deliver excess returns to our shareholders and to our investors, whether that's through a commingled vehicle or through separate accounts. And so we have as our focus investment excellence. And that's what I start all of our meetings with. I start all of our town halls with. And that's what I try to keep us really focused on. If we do that, we will, of course, generate trust and deeper relationship with clients, and we will grow our asset base for sure. But I view that as the outcome of success in investing rather than as the initial goal. In fact, it's not at all clear to me that necessarily my getting bigger is in our investors' interests. Because as we all know, sometimes there actually can be a real kind of push and pull between size and investment performance. So I focus on investment performance. The other thing I would say is that in our industry, there's never been more of a disparity around what does a dollar of AUM bring. If it comes through a passive strategy, if it comes through an active equity strategy, if it comes through an opportunistic closed-end real estate fund, those couldn't be more different. And so I actually manage the business on net revenues rather than on AUM. And it's a much better way of thinking about what's the real inherent economic growth of the business.
I find that approach to be A, inspirational, B, insightful, and clearly it has been successful. Was it the same way in 2012 when you joined PGIM? And the reason I ask that, David, is you have so much AUM today at $1.4 trillion that I would assume the difference between $1.4 trillion, $1.5 trillion, $1.3 trillion, not that big a difference as it relates to overall financial performance. But when you first joined, was the focus still on investment performance? Because it's sort of like, Field of Dreams. If you build it, they will come. You got to have the faith that if you build it, they will come. You clearly, if that was the strategy back in 12, you had the faith that if you built it, they would come.
I did, and I will say, and I give the credit to the two people that really were the CEOs before me in the 20 years of its history, that was when I got here. The ethos was investment performance, and it has to do also with the alignment that we have with our owner, Prudential, the insurance company. So when Charlie Lowry, the CEO of Prudential, calls me and says, "How's it going?" what he means is, how's my bloody investment performance? Because you got a lot of my money, right? As opposed to, how much money do you manage? And I think that alignment of interest, which creates this laser focus on investment performance, has been there from the inception, which is about 35 years now. And what I think I was able to do was to take that and say, I can take that focus on investment performance to new markets overseas and also expand the range of asset classes. But the one thing I don't want to change is that focus on we're investors first and our clients' interests come first.
You talked, David, about Charlie calling you and asking kind of how things are going. How much of your AUM is Pru money versus third-party money that you manage for other investors?
So the better way I would say to look at it is how much of my revenue comes, because again, I have this difference between revenue and AUM. And right now it's about 18% of the PGIM revenues come from some affiliated Prudential structure, whether that's the general account or the annuities business or others. So we are predominantly a third-party asset manager.
Start a legacy. Start turning dreams into realities. A better world begins with you. Better communities start with us.
In 2016, when fixed income was, very, very low, and I'm assuming everyone at Pru was working extremely hard to try and get the actuarial tables to work as it relates to the returns on fixed income. Now you have that, if you will, balance sheet at Pru kicking off what is relatively very cheap capital. How much of a competitive advantage is that to PGIM today?
I think being part of an insurance group has never been more of an asset than it is today, for all the reasons that you just described in terms of where we are in the interest rate cycle. But also, I think that we've always benefited from the fact that the general account of Prudential is willing to seed strategies and is willing to invest in new things that Prudential is doing, which, as you know, banks can't really do. So there's a real advantage to being an insurance-owned asset manager. In addition, what we found is that there's a whole new set of technologies which are allowing us to take advantage of reinsurance. So the insurance industry overall is constrained in capital. And what you've seen us do, and many others, is actually to use reinsurance to bring third-party capital in, and then we are the asset manager that sits behind that reinsurance contract. And that's what the Apollos and KKRs and others have been doing. And certainly you saw us a year ago, and then most recently, just last month, announced these reinsurance transactions, which is bringing in significant amounts of capital, backing them with liabilities, and that we're actually using to drive our private asset growth. Because the liabilities of an insurance company and life insurance are very nice matches for the duration that you get on private assets.
And you just mentioned a couple large asset management firms, private equity firms. As you think about the competitive landscape and sort of, if you will, the melding of the private markets with the public markets, and PGIM clearly sits very significantly in both. As you look at the competitive landscape, David, who's out there? I guess the easiest way for me to ask this is BlackRock a bigger competitor to PGIM than Blackstone versus a Nuveen? How do you look at the competitive landscape that PGIM goes into every day? And is it the private capital, either equity or credit players moving into the public market, or the public players moving into the private market, that presents the bigger competitive threat, if you will?
It's a great way of framing. I mean, for most of our lives, the asset management industry has existed in two very separate ecosystems. There's been the long only managers that largely did fixed income and equities, and there was the privates, which started mostly in private equity, and then more recently got into real estate, and now they're big proponents of private credit. I think both sides have now found that actually the walls between this are breaking down fast. And that's largely being driven by clients. Clients now want somebody who can offer public and private together and can manage a mixed portfolio to a particular risk return profile. So our belief is that the winners in the future will be people who can both offer public and private together rather than keeping those completely separately. So at the moment, what we see as our biggest competitors are those people that can do both of those together. And the number of those is, there's no more than probably 8 to 10 players that actually can really do public and privates together. I would say in general, the other people who are really winning in the market are the big passive players. You mentioned BlackRock, Vanguard, State Street. They're doing very well too. But we offer something very different than they do. We've thought occasionally about getting into passive, and we've always decided, no, we're active managers at our core, and we don't regret that decision at all.
And when you think about the 1,400 investment professionals that you have at PGIM, I think I'm right on that. Is 1,400 about the right number?
Yeah.
So when you think about them, two things. One, private versus public markets, and sort of either the background, the training that those investment managers have. Any difference? At the end of the day, you're looking for very bright people who know how to make the right investment decisions. But anything as it relates to, as you think about, is there any stratification, I guess, inside of PGIM of someone who's on the public securities side versus on the private side, and the way that you go about managing those two businesses?
Well, there are, and in fact, I would argue that the strength of what we call our multi-affiliate model is that we actually have different organizational structures for different asset classes, and I think that's important because their setup is completely different. Just to contrast, too, our public fixed income business basically has all of its employees around 3 hubs. The majority of them are here in Newark on the 8th floor in this building. We have a big group in London, and we have an important and growing group in Tokyo. But that's basically, it's organized around these big trading floors. Now, you look at our private credit business. It couldn't be more different. We have 16 offices around the world. We are calling on companies. We're directly originating loans. And it's a really very distributed model of leadership. And we believe that having people who really know the businesses well and are in those communities are much better at making these private loans, whether they be investment grade or direct lending, than somebody from a central headquarters. So we actually operate these businesses very differently. And we think that's a strength rather than something we want to necessarily bring together.
As I think about those 1,400 investment professionals, many of them have a contrarian view of the world. They're independent. I mean, what you're looking for is investment managers who can find the right time to enter investments and then have the wherewithal to hold those investments and then obviously realize the return once their contrarian play has played out. 2 questions on that, David. The first one is from a management standpoint. How do you manage such a scaled group of what I would call contrarian thinkers?
It's a great question, and I'm really glad that you've focused on this kind of contrarian nature, because as you know, there's no point in having a great investment view if it's already priced into the market. Your best ideas and the ones that are going to generate excess return for your clients are by their nature wrong today in the market. That's an idea that is not yet priced in, and so you've got to be able to have thinkers not only who can develop those non-consensus views, but then you have to have a culture that will back them while they're wrong until they're right. And that can be that can be several years, to be honest with you. And so you need to have a culture that will support people through that journey. So one is the culture of rigorous debate, I would say, which needs to happen to develop those non-consensus ideas. And that's where we believe in meritocracy. We have very rich discussions. It's also where I think the trust and the fact that we have people that have worked together for a long time means that we can have, knockout, drag out debates on a topic and still have a beer together. And I think that that's really important. The second piece of that, though, is the support. So you have to be willing to back your people with those non-consensus views while they don't look so hot in the market and while the headlines go against them and everything else. And, I can think of a whole bunch of examples of that, but maybe most recently our Quant business, which, went like everybody else's through the kind of the quant winter, and people were saying, oh, well, that's going to be lo and behold, here we are. Values come back and quant's now back in fashion. And, we kept the faith in that. And, it's very nice to see that money's coming back into quant and there's real kind of excitement around those strategies again. But you've got to be willing to hold the faith through the cycle. And once your people see that you don't do that, then their willingness to put their neck out and take that risk will go down commensurately.
How do you, it's fascinating to me when I think about holding, if you will, supporting them through that, because clearly in your tenure as CEO of PGIM, there have been some trades that have been put on that are sitting there and they haven't kind of played out to the timeline that is there. And you have had to either double down on it or say, guess what? We've got to give up on this. It's too big a trade. It's too big an exposure. How do you manage that point where you've supported someone through a certain period of time, and then at some point you have to sort of say, okay, we got this wrong for whatever reason. We got to unwind this, take our lumps, and move forward. How do you do that given the scale that you have at PGIM?
So it's a really great question, and I often do think that's the art rather than the science in my job, is that I make judgments about people who make judgments, and that's always an extremely difficult thing to do. But the backbone to make the decision that you're talking about is an outstanding risk management process. So you have got to believe that you can generate and see where the excess return is coming from. You've got to be able to really believe that your attribution of that is clear. So I know whether the idea is moving toward the right direction or the wrong direction. The other thing is you've got to size the bet right. We all know people who, were very contrarian, but they took too big a bet, and they may have ultimately been right, but they got, bankrupt before they got right. So you've got to have a sense of what the conviction level is, and then you've got to make sure that you're sizing the bet to what you can actually believe through the cycle. And the only way to do that is to have a really robust, thorough risk management system that you abide by and that everybody buys into. And I think that it's great to have non-consensus ideas around, but that has to go with guardrails, and that has to go with a really strong risk system that sits behind it for sure.
When you talk about risk management, David, I had Mohammed El-Arian on the Walker Webcast about a month ago, and Mohammed was talking about when he was at PIMCO, how they had their investment committee, and then they had a whole nother committee that's sole purpose was to sort of test the investment decisions of the investment committee. So constantly sitting there and rigorously poking holes in all of the decisions that the investment committee had made. And it reminded me a little bit of Bridgewater and the way that Ray Dalio runs Bridgewater. What's the testing of the investment committee decisions at PGIM look like?
Yeah, not so different, I would say. And we do it in two different ways. One is that we test our investment theses under different scenarios. So I think after a certain age, you get a lot of humility about our ability to predict the future. And we kind of go back to what do we think the probabilities are of different scenarios. And we try to create between 4 to 6 at least inherently consistent scenarios of how the world may unfold. And we test our investment theses against those, and we debate the probabilities of it. And the second thing we do is we try to create a bear case for almost every investment that we have. And we actually have kind of a, cage match between the investment team who will, actually argue for their thesis, and somebody whose job it is specifically to put the bear case of why this won't happen. And those are extremely useful. And just the process of going through it, of having to articulate either why your central thesis is or is not right, is really valuable. And I think that most strong investment processes have some version of that, and I'm sure PIMCO does as well.
Do those decisions ever come up to you in the sense that there's clearly a very rigorous committee structure there? Are there certain differences of opinion that come back to saying, are we either going to keep this trade on or we're going to take it off and David make the call for us?
For the most part, I believe that those decisions are best made by people who are really close to the asset class. Very rarely does something come up out of the affiliates that needs to be adjudicated. I spend a lot of time on the risk bets, the risk budgets, and how we do all of our sizing of bets. But in general, the actual investing of do we want this bond or that bond, or when do we want to sell, that is done in the affiliate levels, and I think probably done by people with a lot more expertise than I would ever bring to that decision.
I will challenge you on that statement, but I get it from a management philosophy, so I'll let that sit. Let me ask you. I heard you talk about chief investment officers that were in their seat during the great financial crisis, and chief investment officers who have assumed their responsibility post-GFC, and how they sort of take a distinct view as it relates to risk and risk tolerance and where they want to kind of put their, what they want to invest in at PGIM. The average tenure of your investment professionals, the 1,400, is, I believe, almost 22 years, 21 plus years. Do you find the same thing in your investment professionals of those who were managing money during the GFC and their basically day-to-day thought as it relates to risk tolerance, and those who have come into their responsibilities after the GFC?
We do. And I think it even maybe goes back even earlier than the GFC, because I think if we're honest, the GFC wasn't really a credit cycle. I mean, we haven't had a really good old-fashioned credit cycle in a very long time. The GFC started certainly as a liquidity cycle, and then we, as you and I know, painfully ended up in real estate and some other things. But it wasn't actually a good old-fashioned credit cycle. And so I do worry that not enough people in the industry have really been through that. We haven't really had the need for workouts the same way that you would think. And so part of the reason we're so proud of the tenure that we have in our profession is they are responsible for training and mentoring and educating the next generation of investors. But when I look out at the industry and I see, the 26 new private credit shop that's just been set up, and it's staffed by a 32-year-old who just spun out from Goldman, I worry. I do. I don't think that those guys have been through that cycle. They don't have an ability to work out the loan. If somebody gives you the real estate keys, they wouldn't know what to do with it. And I think that is a bit of a weak underbelly of some of the developments that we've had. And we are doing everything we can at PGIM to make sure that we don't fall into that trap.
As you were talking about the credit cycle, or if you will, lack thereof during the GFC, I thought you were going to back up to the .com fallout, if you will, where I heard you speak in a previous interview you did, David, where someone asked you about some of the biggest management challenges you've ever faced. And one of the things that I thought was fascinating, and I'd love you to kind of expand upon it, was you said, it's not so much managing, but it's leading your team when something like the .com wipeout happens, where people are they never think that the value is going to come back. They've lost the vision of what they were investing in. And the hardest thing is not to quote unquote manage them, but it's to lead them back to the confidence that markets will return, that capital will come back to their strategy. Talk for that for a moment, because when I listened to that, I said, now that's a true leader right there, who understands that at that time, it's not whether you can manage costs or tell people you got to show up at this time or that time, but really leading them back to the vision.
Yeah, that was a quite a remarkable time, and I actually didn't get it right at all for a while. So I was the leader at that point in McKinsey of our securities practice. And so, we had revenues in our securities practice went from extremely robust in 98, 99 to basically zero by the time we got to the end of 2000. And so we had all of these partners around the globe and all of these client relationships, but clients had no money to pay us. And of course, my first reaction was I got to fix the financials. I've got to find a way. How do we get through all of this? And very quickly, I realized that that was just completely the wrong approach, that actually our clients needed us more than ever. They had incredible problems. They didn't have any money to pay us at the moment, but they actually needed advice and they needed help and they needed problem solvers who could help them in their C-suites. And so we basically just said, basically we're not going to pay too much attention to the economics. We are going to invest in our clients. And we're going to take the view that over the next 5 years, the investments that we make now, they will remember that and we'll find a way to make this up. And bless the firm, they supported that. And I think that that is exactly what happened. But it wasn't my first instinct, and I had to kind of learn that. But I do really believe that if you do what your clients need to, economics will follow. If you spend too much time, machinating over the margin, you will miss the big opportunity that actually is there with your clients.
It's fascinating, and I love you being transparent as it relates to not getting it exactly right at the beginning, but learning as you got the team to focus on that. Anything else from PGIM that was a similar type experience where something happened potentially early on in your tenure back in the teens of 2014, 2015, where there was a certain approach at PGIM which you had taken and as you sort of dove into it, sort of corrected course, if you will, as it relates to what you were trying to manage through?
Well, I would say one of the bigger learnings that we've all had is how to kind of position ourselves over the decade as passive just got bigger and bigger, and obviously really took a lot of share from active managers, and that was particularly true in the equities business. And so most of the people who lost share were folks who were pricing for active, but actually were closet indexers, and so they weren't really generating much value. And I think that we fought that for a while. And then we recognized that actually what we needed to do was have a series of strategies that had much higher tracking error that would work with a portfolio that had at its core some passive. And so we really did move with a lot of our equity strategies to much higher tracking error that have much more of a kind of global growth angle to it from where we were. And it was not obvious that was the right answer at the time, but if you look back on it now, obviously that's been where the huge growth in the markets have been, in those growth stocks, which has been, a lot of it's been technology, but some of it has been some other sectors as well. Pharmaceuticals has been a great example. But that is really what has been working well in at least active equity. And I think if we hadn't made that pivot, we would certainly be looking back thinking we'd wasted a lot of time and probably lost in the fight against passive. And
you and your team back in 2012, 13, 14 called for lower rates for longer and lower growth for longer. And then PGIM invested on that strategy and did extremely well on, if you will, having called those two kind of major macro drivers of markets over that decade from, let's just say, 2012 to 2022. We're now in higher, both on rates as well as right now, relatively speaking, growth. What's the outlook now as it relates to PGIM saying we're either higher for longer, not higher for longer? And is this growth that we've seen in the US versus other developed economies sustainable, or do the others catch us, or do we come down?
So I appreciate your calling out the I think very good macro calls that we had in lower for longer, and I think we were, again, to go back to some non-consensus views, that wasn't what was in the market, and we did turn out ultimately to be right there, although there were quarters when we were not, for sure. But long term, that over the kind of 8 years of that cycle, it was absolutely the right move. Where we are now is we would say that we're going to be higher for longer. We believe that interest rates are actually going to remain quite a bit higher than they were. We think inflation will be higher than it has been historically, and we don't think that's necessarily a bad thing. We think that the U.S. economy is in reasonably good shape at this point. We can come back to some of the geopolitics and some of the challenges in it, but the raw performance in terms of the labor market, in terms of productivity, in terms of output of the U.S., I think has been impressive. And unfortunately, it's been quite impressive at a time when most of the rest of the world has not done very well. Nobody can find growth in Europe to save their lives. China has really been a quite difficult place to put money to work in. Japan has actually been a little bit more of an upbeat market. And then we've gotten some real traction in some of the parts of the emerging markets that have kind of taken on these new supply chains, the Vietnams, the Indonesias, the Mexicos of the world, who've done quite well. But that has been, it's really been a story over the last 24 months of money coming into the U.S. And our belief is that will continue to be a good trade. But it's making CIOs around the world very nervous. And with every new kind of tariff announcement and everything else, all of these guys who've over allocated to the U.S. are definitely popping their pepsins for sure.
You talked about emerging markets, and it makes me think back to I believe your thesis at Princeton was on the emerging market debt crisis.
How in the world do you know all of these things, Willy? That's quite remarkable.
So my question to you is: Are you and your team backing Milei in Argentina and thinking that he can pull out what would be the greatest turnaround of a sovereign default crisis of any country possibly in the history of humankind?
Well, for one thing, you're absolutely right. I did write my thesis on what was then the Latin American debt crisis and kind of what happened with all of that. And I think I've always had an abiding interest in developing economies and what are the policies that make countries, really rebound in a way like which you saw over 30 years that has happened in Singapore or South Korea, what you now see happening in Vietnam or Indonesia, and I find that really exciting. The story, as you know, in Argentina is very sadly been one default after another. And so many of us at various times have thought, okay, now it's going to be better. Now it's going to be better. But each time the reforms don't really hold and it falls back, despite the fact that the country has wonderful natural resources, an educated population, and all kinds of reasons why that should not be true. So I think many of us are really cheering on the economy and the Argentine people and hoping that this will be true. But we are not yet jumping back in as investors. The track record is just a bit too tough.
Yeah. When I think about the strategies that PGIM has, David, and the if you will, overweighting in fixed income, and given where yields were during when you first came into PGIM up until recently, it's got to be a really nice, if you will, turn as it relates to having so much in alternatives and fixed income where the equity markets were, outperforming on those two. Now, all of a sudden, the world is sort of flipped on its head. And my view would be that PGIM and the investments that you all have and the focus that you have is really playing very well in the higher yields on fixed income, on many people looking for alternatives rather than the equity markets. Is my read on kind of the composition of that $1.4 trillion a correct read at this point in the cycle?
Yeah, yes, it is. I mean, happily, 2024 has been a really strong year for PGIM on both kind of flows and earnings and margin point of view after two much more difficult years. And so it's really been nice to be out with some very strong good news. And it has happened through the core public fixed income business as you've described it, but it's also happening through our private alternatives business. So we have about $300 billion in private alternatives. Our fastest growing business is our private credit business, which grew at over 30% this year. And so that business has really nice legs to it. And we think, that will continue. And we think there'll be new asset classes that are kind of very much adjacent to that. The one I would point out mostly would be the asset-based finance business, where we absolutely are seeing, again, banks pulling back out of that and the ability for us to bring in a GP-LP structure and really generate attractive returns has been pretty high. So we had a very strong year in asset-backed, and I think that'll be a big growing business for us in addition to our other securitized products, for sure.
That comment on private credit, I want to kind of double click on that for a second, because the growth in your private credit business has been fantastic. You and I both know there are lots of other private credit shops that have grown dramatically over the past couple of years as banks have moved out of or pulled back from lending to that middle market. As the Trump administration comes in with a general deregulation view, and a lot of talk about whether we might see some consolidation again in the banking sector, do you think that if you were to look forward as it relates to banks' involvement in the opportunity for something like the growth in private credit to expand out, and you just talked about asset-backed lending, do you think that the deregulatory push and the freeing up of the banking system might slow some of those opportunities down, David? Or do you think that really they've pulled back? And I mean, let me just add one other piece to it before I let you talk. But I've thought a lot that what the FDIC and what the new Basel III Accords were going to try and do was basically make the banking system in the United States the lubricant for players like you and me to go actually either make the investment or make the loan. That they're giving them the opportunity to put back credit to us, but that they really have been trying to pull the banks out of the primary market of actually writing loans. And clearly, as either a shadow bank participant or a specialty finance company, you can call us whatever you want to call us, it's been huge to us that Wells Fargo does better lending to Walker and Dunlop and allowing us to go actually make the loan than they do going out and making the loan, just given reserve requirements against that loan for Wells Fargo to do the line of credit to us versus going out and doing it. So the setup to that, I've spoken too much in my real question. So let me go back to my
it's perfect.
Which is just, do you think that banks are now freed to get back into the market, or do you think this trend continues as them being looked at as the lubricant to the market, which then presents opportunities for PGIM and Walker and Dunlop and others?
So I thought, as you originally phrased the question, you moved into kind of M&A and consolidation. I would say I would separate that out from the change in regulation a little bit. I think that as the bank oversight of capital begins to relax a little bit, and I think it probably will, I do think banks will become more free to lend than they have over the last couple of years. And we've already started to see that a bit. But it's all really kind of at the margin, I would say. And we still have a lot of banks that actually are willing to do, joint ventures and partnerships with people like us, where they maintain their relationship, but actually we use our balance sheet and our investors' balance sheets to sit kind of behind that. And I think the appetite for that still remains very strong. If some of the caps on M&A got released and we saw a return to more consolidation, particularly at the high end, I actually think history would say that you see lending contract during a big acquisition and the incredibly complicated putting together of two systems that happen. And generally what happens in there, people realize, oh, wow, I've got too much concentration to now this combined mega bank, and I'm actually going to be looking now for more lenders. And I think that would create more opportunities for you, your business and ours, if that were to occur.
CRE, my understanding is that Prudential at one point was the largest owner of commercial real estate in the United States. You have been a extremely large participant in both the equity as well as the debt markets on commercial real estate. I think you have over $200 billion right now of both credit as well as equity in commercial real estate. Generally speaking, David, what's your view on CRE and growth drivers in CRE at this point in the cycle after 2 years of a great tightening that I don't need to tell anyone who's listening in on this webcast that it's been a challenging 2 years for people who owned commercial real estate, have looked for a loan on commercial real estate. I think I've got earnings next week and we will give our outlook over the coming year, but I'd love to hear your thoughts as it relates to PGIM's exposure to commercial real estate. And do you like being on the equity side or on the credit side right now?
Sure, and it's a little bit of a long answer, and I feel a little strange giving it to you, who is such an expert in this area. But overall, PGIM is the third largest asset manager in the real estate base around the world, and so we actually like the fact that we are very broad-based. We have a, big equity business. Some of that is in core. We also have, particularly outside the United States, some really nice value-added opportunistic. We have a big debt business, which we really like. We also have an agricultural business. So I think it's a nicely diversified business. Over the last couple of years, like everybody, we've seen this business, certainly come under stress, but it's played out in very different ways in different sectors. So our debt business has actually come through this very well. I would say that if you'd asked us right during COVID, we were thinking it was going to be a lot tougher than it ended up being. But boy, the rents keep coming in, and I think we spent really good, particularly in things like apartments and others. We think that actually the damage was minimal, and things have really continued to move up pretty nicely. And so the debt side of this has been very, very good for us. On the equity side, obviously transactions have kind of really kind of almost to a stop, at least for office and to some extent for retail. But surprisingly, industrial has continued on, multifamily has continued on, and some of our specialty offerings like in data centers or senior housing has done well. So it's been a little bit of a tale of two cities. And when most people ask me about real estate, they're really asking me about office. And the reality is I think that the pain has been taken in Europe, and we actually are seeing things begin to rebound a bit. And we would say that, at the turn of the year here, we do believe now is the time to be getting back in broadly into equity in real estate in the U.S. We think that the pain has been taken. We're starting to see really good pickup in transaction values. I would say we're not yet starting to see real pickup, at least in money changing hand on the fundraising side, but the pickup in discussions about changing money has clearly happened over the last couple of months. So we're clearly at a turning point in this cycle. And I mean, as you would know better than anybody, the key to real estate is taking a through cycle view. And if you can come out, back to our original comment, with strong relative investment performance out of the cycle, you're going to do well. And I'm very pleased to say to you that our investment performance for our real estate investors is very good around the world. They will remember that as they come back to real estate. I think we're going to see a real acceleration of our business over the next couple of years.
I love that you said when people ask you about CRE, they really are just trying to get you to talk about office. I am just like you, fortunate enough to go on CNBC every once in a while, and I get on the stage, and invariably they'll sit there and say, "So what's going on in Manhattan office?" And I'm like, guys, I'm not your expert on Manhattan office. I can tell you all sorts of things about commercial real estate, but I'm not. You can ask a lot of other people about Manhattan office.
And invariably they ask you about last week some building on 3rd Avenue traded, and they've done all the research on that.
Exactly.
It's very hard to counter that narrative.
It is very much so. I want to pick up on what you said there, though, David, because I think it's something that is so interesting about both your leadership and then also the outlook at PGIM. The difference between institutional investors and retail investors, the ability to take a longer view of things. And I've listened to you talk about this, and I've been super impressed with the ability to take the long view, the ability to sit there and say, well, the real question I want to ask here is this: the difference between risk and volatility. And talk for a moment about risk and volatility, because what I've learned from you, from listening to you speak about this, is that vol isn't bad. Vol actually gives the opportunity for people to get a good entry point into an investment, and that it's really the risk that you're trying to calculate and then go on that into the risks you all are seeing in the market and whether they're actually correlated to the investment.
No, I'm really glad you brought that up, because I think it's so important, and the media does us all a great disservice, because I think they really do equate daily changes in the stock market or the bond market to volatility and risk. And yet, as you and I know, unless you sell an asset for less than you bought it, or unless you permanently impair an asset, the daily mark-to-market doesn't really change the value that you own. And so we really think that a lot of these kind of volatility and value at risk models are very wrong in the direction that they send you. Because if you're a long-term investor, what a lot of the volatility does do is allow you a better point of entry. The biggest problem we all have right now, with the exception of real estate, I would say, but is that everything's very expensive, right? I mean, we look out, the equity markets look really expensive. Credit spreads are at, close to all-time tights. So even though we're optimistic about the economics, we're not getting paid to take very much risk. So we're actually not running our full risk budgets right now at all, not because we don't believe in the economy, but because we're not getting paid to take the risk. And so that is a really important point. Now, if we had a real drop in prices, I think our view to that would be, okay, well, that now gives us a chance to really have a good entry point. And it's one of the reasons that we're excited about real estate now is that we have had that correction, and it's now a really good time in the cycle to get into it. But if you can't take that through cycle view, and you really are trading on kind of the news and the volatility, and unfortunately a lot of retail does operate that way, you end up really sub-optimizing over for your long-term returns.
When you talked previously about your Quant group and how 21 and 22 were challenging years as it relates to the returns out of Quant, and now Quant is looking great. PGIM was one of the really pioneering firms in Quant. Your Quant group started back in the 1970s when I don't know that there was anybody back there other than
we were one of the very earliest.
And Renaissance might have been the first too.
To be honest, this year is our 50th anniversary of our Quant group, and we're actually celebrating that as Prudential celebrates its 150th. But we've had 50 years of Quant, so we've seen the cycle go through a few times, and I think that also gives us courage of our convictions to come through some of these Quant winters, and we know that things will begin to come back. But I must say, it's nice to see that happen. It's of course hard on everybody when a business goes through this cycle, and I would just give a call out to the leadership of our Quant group, PGIM Quantitative Solutions, for kind of holding the whole thing and seeing through the cycle and what the opportunities would be on the next level. And then this year having an extremely strong year. And
that group has just over $100 billion.
I think they closed the year about 110. I think that's right. Yeah.
So big. On that, it's a good segue to technology and AI and how the evolution of technology is going to impact PGIM and the investment world. I listened to you in an interview you did in 2018, David, where you were asked about fintech, and I think the quote, if I remember it off the top of my head, was sort of like the hype about fintech is about as high as it's going to ever get right now in 2018. And as I look back from 2025, where we're at today, to 2018, you basically calling it hyped and all of how it was going to revolutionize the world and do all these different things it's exactly right. Now, I remember being at the JP Morgan Bank CEO conference back in 18 or 19, and they brought up these fintechs or startup companies. And I don't think there was a CEO in the room who didn't think that all of us were going to be completely wiped out by this new age of technology and these companies that could, onboard a new customer with the snap of a finger and 2 cents of investment. And most of the startups that were up on stage are either much smaller than they were at that time with venture capital, or they might have made it through or were acquired by somebody, but it certainly wasn't the revolution that many projected it to be. And so I want to underscore your sort of calling a little bit of the BS on the hype back in 18 on fintech. But it does appear as if we're at the advent of a new age. Talk for a moment about AI and how much of your time and your team's time is focused on either investing in the AI world, AI companies, AI infrastructure, et cetera, et cetera. And then also, how's PGIM investing in making sure that PGIM is up to speed on using AI or investing in AI for your own future?
So I mean, just a little bit of the broader context. So I've spent a lot of my career looking at how technology has been introduced into the economy, how it gets used, and then who have been kind of the winners and losers in that. And one of the things you do see very much in the financial services industry is you go through these cycles where, whether it was the dot-com boom or others, where there is lots of hype around the smaller companies. And there's real excitement and there's narrative, and that does drive fundraising and everything else. But at the end of the day, they ultimately don't have the brand and the customers to make it work. And so for the most part, they get bought out by the larger firms, and that technology then gets actually used by the larger firms for their for their own clients. And that is the model that again I think you saw play out with the fintech piece. It's not that those technologies didn't have an impact, and if you were to look at under the covers at what Schwab does, you would find some of those nifty technologies that we all saw at the conferences. But they didn't succeed as a standalone piece. They needed to be integrated into a broader ecosystem. So when I look at AI, I again see some of the similar things that are happening, where there's a huge amount of excitement, and I think for good reason. There is way too much focus on what's going to be really different as adoption happens in the very near term. So that gets way overestimated. And yet maybe the long-term benefit of some of this maybe is even underestimated, because the potential, I think, is truly staggering. So we are certainly investing in AI. We have quite a lot of prototypes. We are very careful because there's real privacy concerns that have to go around this. But there's no question that we are going to be able to take lots of the kind of rote tasks that happen around any asset management firm, from spreading financials to writing RFPs, even, dare I say, to coding, that now take up a lot of time, which will be done very quickly under AI. So I do think the potential is there. I think it will raise the quality of the jobs that we have. But I also think that adoption is going to take longer than people realize. In some ways, the last week has been a great example of this, where, so Deep Six comes out with its new model. Everybody's racing to kind of figure out how did they do it so cheaply and without some of the new chips. And yet nobody's covering the big story, which is, isn't it wonderful that these large language models are now undergoing real productivity gains, and that it'll be made more cheaply? And while that may be good or bad for individual players who are building and providing chips and other things, for society, it's absolutely a benefit, because lower cost technology is going to be adopted much more quickly. So I take news like what we had this week as actually quite a good sign in the health of AI, not as some, oh my goodness, sign, which is largely how the press has covered it.
If you were to look out at 2035 and have to make a guess as it relates to the way I would size the question is this. You've got 1,400 investment professionals managing $1.4 trillion today. Does that ratio stay intact over the next decade, or are the number of investment professionals needed to manage that 1.4 trillion less? And another way of looking at it you've got a 110 billion of AUM in your quant strategy. Does that grow proportionately much more rapidly as technology is used more effectively to manage money versus the active managed portfolios over the next decade?
So I think that there's absolutely an element where some of the rote tasks will be able to be done with AI, which will mean you can have less people, whether they be investment management people or people who are doing some of the processing in that, for sure. But I think as exciting as that is the prospect of using data in fundamentally new and different ways. I mean, the problem with a lot of data is, first of all, most of us don't do a particularly good job of making sure that we're, storing it, tagging it, and using it effectively, which is what you really need to do to make AI work. But once you do have that basis down, I think that our ability as investors to take in many more types of data than we have now, which is largely financial data, but we're going to be able to use traffic data and satellite data and all kinds of new things in making decisions on investments that AI is going to allow us to do. So I do think that the decision making should be better. And I think that we will be elevating the level of thinking and analysis that needs to be done by a portfolio manager. And I think they'll find that exciting and invigorating.
Talking about exciting, invigorating. You've been an incredible leader of PGIM. What's the most exciting and invigorating part of what you do at PGIM?
So I really do think that that building something is what's really exciting. And I don't need to tell you this, given your amazing track record yourself, but it's really fun to come into something and see the potential for it. To be able to keep the parts of the culture that are really fundamental to the success. And we talked about keeping that investment culture even as we've grown, but at the same time to really expand. We had no assets in Japan when I took my job. We have 200 billion now. We had, I think, 100 people in London. We have 550 now. We had no ETFs. We barely had any SMAs. And now those are big growing businesses for us. And so that notion of growing and building and having clients recognize that with more assets is really fun. It's not always easy, but it absolutely, I think, brings a level of satisfaction because we are meeting the needs of a population that increasingly needs money for retirement, and that is a growth business for sure as our demographics change.
And you launched the PGIM brand in 2016, I think, David. As you built that brand and really invested in it, what's been the most, as you think about all the different brand building things you've done, direct advertising, branding on buildings, branding on, collateral, going to take, sponsoring a golf tournament, all sorts of different things. What's the one that either surprised you the more or seems to be the best bang for the buck as it relates to the growth of the PGIM brand?
So I think that just a little bit of the history to the brand change, which many of your viewers may not be aware of, but there is another Prudential, and it's based in the UK. It's Prudential PLC. They use the red color. We have the blue color, but basically it meant that we could not use the Prudential name in pretty much all of Europe and almost all of Asia, other than Japan. So when I came into this and I wanted to build a global, unified asset management business, I couldn't use Prudential in the name. So I had to find some other formulation that I could use everywhere in the world. And so we tried, as you can imagine, all kinds of different formulations of this. And, PGIM is the one that seemed to roll off the tongue most easily and didn't mean anything terrible in any other language, which is always a key thing for these things. But anyway, we ended up with that. I would say the answer to your question is that the most powerful thing is ideas. So you can put your name on the back of the bus all you want. You can buy the outdoor advertising all you want. But what really stays with people is if you have powerful ideas, which you can deliver at conferences, on TV, on podcasts, and whichever way, but ideas that stay with people. And if that's what you have, that's what will gain you the share of, we don't need that many people to know who we are. We're not a pure retail brand. And so if you can gain share of boy, I heard an interesting idea. I heard an interesting investment theme. That's the most powerful piece of that. And that needs to be done actually by your investment professionals. It's not almost a marketing tactic.
It's fascinating. I have to tell you, I love hearing you say that. I absolutely love hearing you say that. And it is so contrarian. It's sort of like you saying, if we get great returns, the AUM will come. It is exactly what actually does it, but it's not the way most people approach those two issues. It's really quite something, David. I absolutely love it. Final question, because I'm running out of time and I could keep going all day with you. And you've been extremely generous with your time, and I've loved our conversation. I know you are a tennis fan. I know you play tennis, and you also go and watch the majors, particularly when they're in New York at Flushing Meadows. What's your favorite major tournament? I'm assuming you've gone to all of them. If you haven't, then you can say I haven't gone to Australia and seen the Australian Open. But I was just curious: is there one that you like more than others?
So they're all different, and they have their own charms. I actually have not been to the Australian. I have been to the stadium there. Every time I go to Melbourne, I go and we just walk around the grounds. But I've never actually managed to get there for a tournament. But I've been to the other
call
three.
me, because I have a friend who's down there who.
Okay, great.
So give me a call.
But they have their own charm. I mean, I do love the French. There's nothing more beautiful than the way that they put on a tournament, and there's something wonderfully elegant about the clay and the tennis that's actually played on clay. Wimbledon remains, without a doubt, one of the most prestigious events of all of it, and that's always fun to see. And the U.S. Open couldn't be more different. Right, it is a festival, a 2-week festival of tennis, where half the people that go don't actually spend that much time watching tennis, and yet it has become this wonderful spectacle for New York City, and everybody goes. It's the single thing that funds all of the tennis outreach for the USTA across the U.S. And so that is what's paying for the development of our players and all the community programs that they do. And I couldn't be more delighted that that's turned out to be, a really, really successful venue, and was again this year. But tennis, like all sports, is a great unifying force, and we need more and more of those in today's environment.
I know you're on the board of the Lincoln Center. You're going to be able to see Renee Fleming when she's performing over the next couple of weeks at the Lincoln Center.
Absolutely, just phenomenal. And in general, it's so nice to see the arts really coming back now. I mean, COVID. Talk about an area that really got hit with COVID. The arts really struggled, and even Broadway is now just barely kind of coming back. But you can feel it this year. There's a real energy and an upbeat, whether it's on Lincoln Center campus or down within the theaters, and that's really important to the city.
Well, I'm super appreciative of the insight and the energy and the engagement that you brought to the Walker Webcast this week. Thank you, David. Congratulations on all you've done at PGIM. It's an incredible tenure. It's an incredible growth story. It's an incredible company. And I'm very appreciative you taking the time to share your thoughts for the last hour with all of our listeners, and really greatly appreciative.
No, it's really a pleasure to be with you. I've enjoyed our conversation so much, and I'm really happy you'll be able to get back out to the slopes. I don't want to keep you for another minute. So thanks for having me.
Thanks, David. Take care.
Thank you.
Bye-bye.